Hi, welcome to FinFlow Podcast. Have you ever looked at your finances and felt like, you were just constantly playing catch up, or maybe felt that there simply had to be a smarter, more intentional way to build wealth?
Oh, absolutely. That feeling of treading water financially.
Exactly. Or perhaps you've scrolled through headlines, seen those big success stories, and thought, okay, what am I missing? What critical piece of the puzzle don't I have? What do genuinely successful people really understand about money that I just don't get?
It's a remarkably common feeling, isn't it? That sort of quiet frustration, knowing there's probably a better path, but not quite having the map, or maybe having too many maps pointing in different directions.
That's it. Well, today we're aiming to hand you something like that map, or maybe distill the best parts of several maps. We've taken a really deep dive into some of the most, I think, influential and genuinely transformative ideas out there about money and investing. These aren't just fleeting fads, they're often foundational concepts that have really reshaped how millions approach their financial lives.
Foundational is the right word. Stuff that changes how you even look at a dollar bill.
Right. So our mission today is to try and cut through all that overwhelming noise you hear everywhere, the blogs, the gurus, the conflicting advice. We want to bypass the superficial stuff and really distill the absolute core transformative ideas from this powerful body of wisdom. We're here to bring you the essential insights, the concepts that can truly shift your perspective, maybe illuminate your financial journey a bit, and hopefully equip you to avoid some of the common pitfalls. Think of this as maybe your focus briefing on understanding the financial world better. We'll even try for some surprising facts and hopefully just enough humor to keep things interesting.
It's so true, though, the paralyzing effect of too much advice. It's overwhelming. One expert tells you to save every single penny like your life depends on it. Another insists you absolutely must spend on experiences for a fulfilling life, while a third is championing, super aggressive investing strategies from day one.
Yeah, it's like financial whiplash.
Exactly. It's a cacophony of conflicting voices, making it incredibly challenging to figure out where to even begin, or, maybe more importantly, what advice genuinely matters in the long run. But what's truly fascinating when you dig into it is how often the most profound and impactful insights aren't about, complex algorithms or predicting the market or finding some secret niche investment.
Right, it's rarely about a hot stock tip.
Precisely. Instead, they usually center on these fundamental shifts in how we think about money, and maybe even more critically, how we act with it, our habits, our psychology. These are the underlying principles that once you genuinely grasp them and start applying them, can unlock a completely different, far more empowered approach to your financial life. They help cut through all that noise with some real clarity.
Absolutely. And to kick off this deep dive, let's go right to the heart of some ideas that for many people were their very first big aha moment in personal finance.
Huh.
I'm talking about the core concepts often associated with, well, the rich dad, poor dad philosophy.
Ah, yes, a foundational one for so many. Divisive sometimes, but foundational.
Exactly. It's a classic for a reason, but it's also one of those philosophies that sparks intense debate. Some people champion it as revolutionary thinking, while others kind of dismiss it, maybe because it doesn't offer a super detailed step-by-step plan.
Right, they want the exact blueprint, not just the mindset shift.
But its core premise is just undeniable. It lays down these fundamental concepts about money that, frankly, most of us just aren't taught in school or even at home sometimes. The narrative often used is this upbringing influenced by two contrasting father figures. There's the poor dad figure, often portrayed as highly educated, advocating the traditional path. Get good grades, find a secure job, climb the ladder, rely on a pension for retirement, the safe route.
The path most of us are implicitly or explicitly guided towards.
And then there's the rich dad figure, maybe someone who didn't have the same formal education, perhaps even a dropout, but who built businesses, championed independent thinking, and relentlessly focused on one thing: buying assets, things that generate income.
That contrast is the whole point, isn't it? It's less about the individuals and more about the opposing philosophies of money.
Precisely. It's not just a story. It's a profound lesson in financial philosophy. How do you fundamentally view the purpose of money and work?
And this contrasting philosophy, as you said, is exactly where that core lesson really hits home. The critical, often completely misunderstood distinction between assets and liabilities.
Ah, the big one. Seems simple, but it trips people up constantly.
It really does. And this isn't just, dry financial jargon for accountants. Getting this right is a fundamental shift in how you categorize and perceive pretty much everything you own or owe. It basically dictates whether your financial ship is steadily sailing forward or maybe taking on water without you realizing it.
So how is it usually defined in this context, the simple version?
The simple, elegant definition is an asset is anything that puts money into your pocket consistently, predictably. Think investments that pay dividends, like certain stocks, or real estate that generates rental income each month.
Or even a side hustle?
Exactly. A successful side hustle that brings in extra cash. Or a business you own that provides profits without needing your constant, direct, hour-for-hour labor. These are the financial engines. They fuel your wealth creation.
Okay, so assets feed you. What about liabilities?
Liabilities are the opposite. They take money out of your pocket, and crucially, they often lose value over time as well. Think about car payments, credit card debt carrying interest, maybe even subscriptions you don't use. These are the drains on your cash flow.
Things you actively want to minimize, especially when you're trying to build something.
Precisely, especially during your wealth building years. Understanding this seemingly simple difference is just paramount because it clarifies the real nature of how wealth is actually built. It's not primarily about how much you earn in your paycheck, though that matters, of course.
It's about what you do with it.
It's about how much you keep, and perhaps even more importantly, how hard that money you keep works for you independently of your own labor. It's about getting your money to make more money.
And this perspective really challenges that conventional wisdom, doesn't it? The idea that just getting a good job and a high salary is the ultimate goal.
It does, because that traditional view often leaves individuals feeling financially trapped, even with high incomes, precisely because this foundational asset liability concept isn't taught well in our schools or even discussed much. Without truly internalizing this difference, people are often ill-equipped to make sound financial decisions right from the start. They might buy things they think are assets, but which are actually liabilities, draining their resources month after month.
And what's particularly provocative, and maybe where some of the debate comes in, is how this philosophy challenges one of the most deeply ingrained beliefs, certainly in Western society, that your primary residence, your home, is always a fantastic investment.
Ah, the sacred cow of personal finance for many.
Right. The idea presented is that viewing your home as your main, or perhaps only, major investment can actually be a significant financial trap. Why is that?
Well, the argument goes like this. When you buy more house than you genuinely need, or stretch to afford the absolute maximum the bank will lend you, you end up sinking a huge, disproportionate amount of your monthly income into things that don't put money back in your pocket.
You mean the mortgage payment, obviously.
Yes, the mortgage payment, which is largely interested in the early years, but also property taxes, homeowners insurance, ongoing maintenance and repairs, which always seem to cost more than you expect.
Oh, tell me about it. The leaky roof, the furnace that dies.
Exactly. All that money, the argument goes, is money leaving your pocket every month. And crucially, it's capital that could potentially have been deployed much more profitably elsewhere.
Into actual income-generating assets.
Precisely. Channeled into things that put money into your pocket, like dividend stocks, rental properties, or building that side business, rather than being locked up in a single large purchase that, while it might appreciate in market value over the very long term,
It typically drains your cash flow month after month in the meantime.
that's the core of the argument. It forces you to think critically, not just about the potential future sale price of your home, but about the immediate cash flow impact it has on your finances right now.
And the opportunity cost.
Yeah.
What else could that money be doing?
Opportunity cost is huge. What could that hefty down payment and those significant monthly payments have achieved if invested differently over the same period? It's a powerful invitation to question societal norms and really redefine what a true financial advantage looks like for you.
It's not necessarily saying don't own a home, right? It's more about understanding its true financial role.
Exactly. It's about being clear-eyed about its impact on your cash flow and your overall wealth trajectory, rather than just blindly accepting the home ownership is always the best investment mantra. Sometimes it is, sometimes it isn't, depending on your goals and the numbers.
Okay, that makes sense.
Yeah.
It's about conscious decision-making.
Precisely. And this way of thinking leads directly to another incredibly powerful mindset shift often associated with this philosophy. The idea of treating every single dollar you possess as an employee.
Like a little worker you send out.
Exactly. You give each dollar a specific job, a purpose. You direct it to work tirelessly for you, 204/7, rather than just letting it drift away on impulse buys or things that don't build future value. Imagine each dollar bill punching a time clock.
Okay. I like that visual.
This reframing instantly clarifies the profound trade-off between present consumption and future prosperity. Every single dollar you spend today on something that isn't an asset or isn't a strategic investment in your skills or future income,
It's a dollar that can't work for you anymore. It's off the clock.
it's off the clock permanently. It won't be able to grow for you, compound for you, or generate future income for you. It's a lost opportunity for that dollar's potential future earnings. This perspective transforms your relationship with money. It stops being just this passive medium of exchange and becomes an active, dedicated workforce that you are responsible for managing effectively, like a CEO managing their team.
So it's not just about being frugal or cheap, it's about being strategic with your capital.
Exactly. It's about intentionality and leverage. You become the CEO of your own financial capital. And this particular insight, seeing money as a tool to make more money, really sets the stage for thinking about earning money in new, non-traditional ways. It moves you beyond just the conventional notion of trading your time for a paycheck.
Yeah, it starts you thinking, how else can income be generated?
Precisely. It sparks new ways of thinking about how your money can generate more money, independently of your direct labor, which is a perfect segue, actually.
It really is. Which brings us perfectly to the next logical step in this journey. Understanding that there are literally hundreds, maybe thousands of ways to earn money that go way beyond the conventional 9-to-5 job structure.
The path most people are locked into, or feel locked into.
Right. Many of us are conditioned, maybe from a young age, maybe by society, to believe that a stable job, a W-2 position, is the only legitimate, secure, and realistic path to financial security. But as some of these financial philosophies compellingly reveal, that perspective can be incredibly limiting.
Limiting both in terms of your ultimate income potential and perhaps just as importantly, your lifestyle freedom and flexibility.
Absolutely. And this is exactly where the ideas in, say, the cash flow quadrant provide such an invaluable framework. It introduces this concept of 4 distinct ways people earn money.
Laying out a broader map of financial engagement, you could say.
Yeah, exactly. Each quadrant has its own pros and cons, its own mindset, and crucially, different paths towards financial freedom.
Yeah.
So can you walk us through those 4 quadrants?
Sure. So imagine a plus sign dividing a box into 4 sections. On the left side, top left, you have E for employee. This is someone who works for somebody else, typically trading their time for a salary or wages. It's the most common quadrant.
Okay, got it. E for employee.
Bottom left, you have S for self-employed or small business owner. Think of a doctor with their own private practice, a freelance writer, a consultant, maybe a small shop owner. These individuals essentially own their job. Their income is still directly tied to their own efforts and time. If they don't work, they generally don't get paid.
Right. They might have more autonomy than an employee, but they're still trading time for money, essentially.
Exactly. Now, the real shift, the potential game changer, according to this model, lies on the right side of the quadrant. Top right, you have B for big business owner. This is someone who builds and owns systems that operate and generate income, often without their constant, direct, hands-on involvement.
So they're leveraging other people's time and established processes.
Precisely. Think of a CEO of a large company with hundreds or thousands of employees, or the owner of a successful franchise system. They've built something that makes money whether they show up every day or not, because the system runs itself to a large degree.
Okay, B for business system owner. And the last one.
The last one, bottom right, is I for investor. This is where your money is actively working for you. You're using capital to buy assets, stocks, bonds, real estate, maybe even investing in other people's businesses that generate returns and build wealth more or less autonomously. Your money is making money.
So E and S on the left, B and I on the right. What's the core message there?
The core message, the powerful insight, is how relying purely on the E or S quadrants, while providing necessary income for most people, fundamentally limits your potential for true financial freedom because your income is almost always directly tied to your personal time and effort. There's a ceiling.
You only have so many hours in a day to trade.
Exactly. The framework guides you toward understanding which of these paths, particularly the B and I quadrants, are more likely to lead you towards genuine financial independence by decoupling your income from your direct labor. It's about leverage.
So while it might not give you like a step-by-step, do this, then do that plan.
Right. It's not a granular roadmap in that sense.
It's excellent for just sparking possibilities, getting your mind ticking with ideas about different ways to structure your financial life.
Absolutely. It gets you brainstorming new ways of creating income streams that extend far beyond just trading hours for dollars. It opens up the menu of possibilities.
And if that cash flow quadrant idea acts as the broad, eye-opening map showing you these possibilities, then the concepts in something like the 4-hour workweek philosophy hand you the actual compass and maybe a toolkit to navigate that map, perhaps even at a faster pace.
Ah, another one that caused quite a stir with its title.
Oh, definitely.
Yeah.
I'll be honest, when I first heard that title, The 4-Hour Workweek, I was incredibly skeptical. I thought, come on, 4 hours. That sounds like pure fantasy. You know, one of those claims that's just too good to be true, destined to disappoint.
A common reaction, I think. It sounds like a gimmick.
But then as you dig into the actual ideas, you quickly realize it's not really about working less just for the sake of being lazy or idle.
Hmm.
It's fundamentally about working smarter, maximizing efficiency, using leverage, and designing your life with real intention.
Focusing on output, not just hours logged.
Exactly. It introduces concepts like lifestyle design and challenges the whole deferred life plan. It calls for achieving what's sometimes termed a retired millionaire lifestyle. Not necessarily by having millions banked by age 65, but by structuring your life now to have the freedom and income to live how you want.
How does it suggest doing that? It still sounds a bit aspirational.
Well, it involves things like building and, crucially, automating businesses, often online businesses that can be run from anywhere. Setting up sophisticated systems using technology, delegation, outsourcing to collect income with minimal ongoing time investment from you.
So leveraging those B quadrant principles we just talked about, building a system.
Precisely. It advocates for becoming part of the new rich, defined not just by net worth, but by those who prioritize time and mobility over simply accumulating money for its own sake, only to enjoy it decades later.
It's about freedom now, not just security later.
Right. And it's a masterclass in applying principles, like the Pareto principle,
Yeah.
the 80-20 rule, identifying the few critical tasks that yield most of the results, and ruthlessly eliminating or delegating the rest.
Focusing on the vital few, ignoring the trivial many.
Exactly. Strategic delegation, leveraging digital tools, the power of remote work. These were quite radical ideas when first popularized, though more mainstream now. It's truly illustrative of how goals that seem completely far-fetched, things that feel utterly out of reach.
Are often a lot more achievable than you initially think if you approach them with the right strategy and a willingness to challenge conventional thinking about work and income.
Absolutely. So these two sets of ideas really go hand in hand, don't they? The quadrant philosophy opens your eyes to the different ways of earning, beyond the job.
It shows you the landscape.
And the 4-hour workweek type thinking gives you actionable steps, the actual tools, the mindset shifts to potentially make that new reality happen. It's like one shows you the possible destinations and the other shows you how to build a metaphorical jetpack to get there faster.
It's a powerful combination, no doubt. And building on that kind of momentum, that challenging of conventional paths, we can turn to the ideas in the millionaire fast lane philosophy. This introduces a somewhat provocative, yet I think deeply realistic concept.
Provocative how?
It directly confronts much of the standard financial advice we often hear. The core idea put forth is that there's no such thing as get rich easy, no magic bullets.
Okay, that sounds reasonable. Hard work is usually involved.
Right. But crucially, the argument is that there is such a thing as get rich quick. Now, that phrase immediately raises red flags for most people, right?
Yeah, get rich quick usually makes me think of scams, pyramids, things that are unsustainable or illegal.
Yeah.
It has such a negative connotation.
Exactly. But this philosophy reframes it entirely. It does this by clearly delineating three distinct financial paths people tend to follow in life, each leading to vastly different outcomes.
Okay, what are the three paths?
First, there's what's called the sidewalk. This is where individuals are pretty much consistently spending everything they earn, or maybe even more. They're often trapped in a cycle of living paycheck to paycheck, probably burdened by consumer debt, and never really getting ahead financially. It's a reactive, often quite desperate way of handling money.
Just trying to keep your head above water, basically.
Pretty much. Then second, you have the slow lane. This is the traditional path, the one we're usually encouraged to take. It involves diligently pursuing good grades, landing a secure job, maybe getting promotions, saving a modest portion of your paycheck, consistently maybe 10–15% investing it, often in diversified funds like mutual funds or index funds.
And then eventually retiring, hopefully comfortably, somewhere around age 65 or maybe even later.
Exactly. It's presented as the safe, sensible, responsible route, the tried and true method.
Okay, sidewalk, slow lane. What's the third? The fast lane.
That's right. And the critique of the slow lane is quite significant here. The argument is that while it seems safe and stable, it's fundamentally a very slow game, decades slow. And your primary input is trading your finite, irreplaceable time for money.
Your earning potential is largely capped, right?
Yeah.
By your salary, maybe some bonuses, and the relatively linear growth of typical investments over time.
Precisely. Your income potential is capped. And furthermore, it often explicitly defers true financial freedom, the real ability to live life completely on your own terms until a very distant future, often well into old age when your health or energy might be declining.
Trading your youthful energy for future security, essentially.
That's one way to put it. Now, the fast lane, in contrast, fundamentally involves leveraging your time, skills, and initial effort to create passive, or more accurately, scalable income streams.
Okay. How does that work in practice? What does leveraging mean here?
It means strategically investing your upfront work, which might be intense for a period, into building things like products, services, or automated systems that continue to generate income long after that initial heavy lifting is done.
So creating something once that pays you many times.
Exactly. It's about building an engine, maybe a business, a piece of software, a popular book or course, a portfolio of rental properties managed by others, something that keeps producing revenue largely independent of your hour-to-hour input. This allows you to potentially expand your income potential far beyond what a linear salary can offer, and potentially do so in a much more accelerated time frame than the slow lane.
This sounds a lot like the business owner and I investor quadrants
It
again.
aligns very closely, yes. It's about intentionally designing your income streams for scalability and leverage, rather than just accepting the default path of trading time for money within a traditional job structure.
Mm.
It's about architecting your financial life.
And what I really appreciate about this fast lane concept, and what makes it compelling rather than just hype, is the emphasis on realism. While it talks about get rich quick, it keeps it incredibly grounded.
It's not presented as easy, right?
Not at all. The message is loud and clear. This fast lane is absolutely not possible without immense hustle, serious hard work, unwavering discipline, and probably dealing with a lot of failures along the way. It's not some magical shortcut where you just wish for wealth and it appears.
So quick doesn't mean effortless.
Far from it. It demands strategic thinking, calculated risk-taking, continuous learning, and just relentless effort, especially in the beginning stages of building that income engine.
Right.
What might look like getting rich quickly from the outside,
Hmm.
that person who suddenly seems like an overnight success.
Yeah, you always hear those stories.
In reality, that's almost always the combination, the visible tip of the iceberg, representing years of accumulated experience, deep knowledge, consistent daily grind, and often numerous setbacks and pivots that nobody ever saw. It only appears quick in hindsight, after all that foundational, often invisible work has been done.
So the quick part refers more to the potential rate of wealth accumulation compared to the slow lane, not the lack of effort required to achieve it.
Exactly. This framework provides a truly intentional and potentially accelerated way to think about wealth creation, moving beyond just passive saving and into active building system creation and value delivery at scale. It's not about avoiding effort, but strategically redirecting that effort towards activities that create leverage and scalability, rather than just linear time-bound income.
Okay, so we've talked a lot about the structural and strategic aspects, assets versus liabilities, income quadrants, different paths like the slow lane and fast lane. These often focus on external actions, systems, tactics.
Right, the what to do.
Exactly. But now let's pivot our focus pretty sharply inwards to what might be called the inner game of wealth. This is all about the profound role of psychology, our ingrained mindsets, and the deeply held beliefs that ultimately underpin almost all of our financial decisions and behaviors.
The why we do what we do with money.
Precisely. And this is where we encounter the ideas often associated with, say, think and grow rich thinking. This is legendary stuff in the self-help and success literature world, but it's also one of those philosophies that tends to be quite polarizing.
Yeah, I've definitely seen that. People seem to either absolutely love it and credit it with changing their lives, or they dismiss it completely as, fluff or wishful thinking. There doesn't seem to be much middle ground.
That's very true. Why do you think it gets that fluff label from some people?
Well, I think many people pick it up expecting a clear, actionable roadmap to getting rich. Like step 1, do this. Step 2, invest here. They're looking for concrete financial tactics.
A literal instruction manual.
Right. And when they don't find that specific, detailed how-to guide, they feel disappointed, maybe even misled by the title. They feel it didn't deliver on its promise.
So the expectation mismatch is key.
I think so. But then, on the flip side, you have countless individuals, entrepreneurs, leaders, regular folks who absolutely credit this type of thinking with completely transforming their mindset about possibility, about their own capabilities. And as a direct consequence, they feel it changed their financial lives.
For them, it wasn't about the tactics, but something deeper.
Exactly. For them, it was about a profound light bulb moment. It helped them identify and maybe start to unlock these deeply held, often unconscious, limiting beliefs they had about money, about success, about what was possible for them. It showed them what was mentally holding them back.
And my perspective tends to align more with that latter group, but with a really crucial caveat attached. When it comes to achieving significant success, particularly financial success, your mindset isn't just a factor. In many ways, it's the foundational everything. It sets the stage.
How so? Can you elaborate on that?
Well, think about it. If you approach life, and specifically money, with a deep-seated scarcity mindset, constantly believing that there's never enough to go around, that money is inherently difficult and stressful to acquire, or maybe even that you, personally, are somehow not worthy or capable of substantial wealth.
Those beliefs feel very real to the person holding them.
They feel absolutely real, and those beliefs will often, subtly or overtly, manifest as your reality. They'll unconsciously guide your decisions, your actions, your reactions towards outcomes that actually reinforce those very beliefs. You filter opportunities through that scarcity lens.
You might miss opportunities that don't fit the money is hard narrative.
Exactly. Conversely, if you actively cultivate an abundance mindset, genuinely believing that you are capable of achieving wealth, that opportunities are plentiful if you look for them, and that you deserve prosperity and success, then your actions will naturally start to align with those empowering beliefs. You'll approach challenges differently, you'll see possibilities where others see roadblocks. Your behavior follows your core beliefs.
So for people who are open to exploring those inner beliefs, especially the subconscious ones,
Yes, for those open to that kind of self-examination, challenging their deeply held assumptions about money and success, this kind of thinking can indeed be a profound catalyst. It can illuminate the internal barriers, the mental prisons we often unknowingly erect for ourselves. It's about understanding that our thoughts aren't just fleeting background noise. They are powerful architects shaping our experience and our results.
okay, I can see the power in that. But, and I feel like this is a very big, but mindset alone is just not enough, right? It can't be the whole picture.
Absolutely not. That is the crucial caveat I mentioned. It's perhaps the biggest misunderstanding surrounding these ideas.
You can have the most positive, rah-rah, abundance-oriented mindset in the entire world. You could believe with every fiber of your being that you're destined for immense wealth. You could visualize it daily, affirm it hourly.
Chant mantras until you're blue in the face.
Right. But if you're not actually doing anything, if you're not taking concrete, consistent, focused action out in the real world, you're quite literally not going to get anywhere. You'll just be a very positive person sitting on the couch.
It's like having the most exquisite, state-of-the-art toolkit imaginable in your workshop. The finest German hammers, Japanese saws, precision drills, and maybe even the architectural blueprints for a magnificent house.
But you never pick up a single tool.
Exactly. You just admire the tools, maybe polish them, talk about how great they are. The tools, however excellent, are utterly useless without consistent, focused action directed toward actually building the house. Mindset is the blueprint and the motivation, but action is the construction crew.
So the key takeaway then, the critical synthesis from this kind of power of thought philosophy, combined with all the practical, actionable ideas we've discussed, is that you absolutely need both.
It's a synergistic relationship. They amplify each other.
You need the right, expansive, possibility-oriented mindset, and you need the deliberate, consistent application of that mindset through focused, real-world action. It's not an either situation, it's a powerful combination. One without the other is incomplete.
Mindset without action is delusion. Action without the right mindset is often inefficient, directionless, or easily derailed by setbacks.
That makes perfect sense. So if you're listening and you feel like you need some philosophical improvement at your core money beliefs, if you want to dig deep into your inner game and maybe dismantle some self-imposed limitations about wealth,
Then exploring these mindset-focused ideas can be invaluable, a great starting point.
but if you're just seeking a direct, step-by-step financial plan, a how-to guide, without doing that internal work on your beliefs and habits,
You might find it more beneficial to couple the mindset work with some of the other more strategy-focused or tactical approaches we're discussing. The mindset work is like clearing the runway. The strategy and action is the plane taking off. You need both for a successful flight. And this focus on the internal landscape leads us very naturally to the insights from the psychology of money thinking. This contemporary perspective really delves into the fascinating, often counterintuitive interplay between our human minds and our financial lives.
Yeah, this is a big one too. The idea that money isn't just math.
Exactly. It makes a profoundly compelling case that understanding money, truly mastering it, is as much, if not significantly more, about understanding psychology and human behavior than it is about grasping complex mathematics, economic theories, or intricate financial formulas.
Our brains aren't calculators, basically.
Not when it comes to money, no. The argument is that our minds perceive and interact with money based on deep-seated feelings, powerful cognitive biases, our unique personal histories and past experiences with money, and these emotional and experiential factors often overshadow and sometimes completely override the purely rational financial knowledge we might objectively possess.
We think we're being logical, but our feelings are really driving the bus.
Often, yes. We're not the perfectly rational economic agents that old school economic models assumed. We're emotional, often irrational, beings navigating a world filled with numbers, uncertainty, and high stakes.
And for me, one of the most interesting, maybe even slightly controversial parts of this psychological perspective on money is how it highlights the role of luck or chance, how often we misattribute success or failure.
Ah, yes, the luck versus skill debate, always a fascinating one.
Right. The point is often made that most of us learn or try to learn what to do and what not to do about money
Mhm.
by studying the most extreme examples, particularly the most exceptional financial success stories.
We look at the billionaires, the legendary investors, the outliers.
Exactly. People like Bill Gates, Warren Buffett, Jeff Bezos. We tend to analyze their paths, their decisions, their famous strategies, hoping we can somehow replicate their incredible achievements in our own lives. We're searching for their secret sauce.
We want the formula for guaranteed success based on the biggest winners.
But here's the counterintuitive insight. The more extreme, the more exceptional or outlier a particular success story is.
The more likely it is that pure luck, random chance, good timing, or an exceptionally rare convergence of unforeseen circumstances played a significant, often unacknowledged role in that specific outcome.
Meaning it wasn't just skill or strategy.
Precisely. Skill and strategy were almost certainly involved, but luck might have been the massive amplifier, the unpredictable tailwind that turned a moderate success into a legendary one. And because luck, by its nature, is random and unrepeatable.
It means there are fewer truly concrete, universally replicable lessons you can actually extract from that specific, singular outlier story and reliably implement into your own life, which will have its own set of circumstances and luck factors.
It's a crucial distinction. It wisely steers us away from trying to copy the uncopyable, right? From chasing these financial unicorns when maybe we should be studying the patterns of successful but perhaps less spectacularly famous horses.
That's a great analogy. Trying to replicate the exact path of someone who got incredibly lucky with, say, timing the market perfectly or being in the right place at the very right time.
You're often just setting yourself up for disappointment because you simply cannot replicate their specific dose of luck or their unique starting conditions or the environment they operated in.
So instead of trying to mimic these individual exceptional people, what's the recommended alternative?
The more reliable approach suggested is to pay much closer attention to broad patterns of behavior and strategy rather than focusing intensely on individual outlier stories.
Patterns across many successful people, not just the one superstar.
Exactly. Think about it like this. If, say, one person achieved phenomenal success by taking a highly improbable route A, maybe they invented something revolutionary completely by accident or bought a lottery ticket that won big.
Highly unlikely, relies heavily on chance.
Right. But let's say 10 or 50 or 100 other people achieved significant sustained financial success by diligently and consistently following a well-trodden route B. Maybe disciplined saving and investing, starting scalable businesses in established markets, steadily acquiring income-producing assets.
Route B sounds much more repeatable.
Chances are, Route B is the far more reliable and replicable path for you to study and potentially emulate. That's because Route A might have been heavily reliant on that unique stroke of luck, that once-in-a-lifetime opportunity, or that exceptionally rare set of circumstances that you simply can't engineer. Route B represents principles that work more consistently across different people and different times.
So, by focusing on these patterns, you identify the key fundamentals.
Yes. You identify the consistent principles the universal behavioral tendencies, both good and bad, and the foundational strategies that apply more broadly to almost everyone, irrespective of their individual luck factor.
Things like diversification, managing costs, avoiding emotional decisions, the power of compounding.
Exactly. These are the proven strategies, the consistent truths observed over long periods in the world of money. They guarantee a much higher probability of success because they rely on observable, repeatable dynamics and sound principles, rather than singular anomalies or lottery wins.
It really reinforces that understanding human behavior, our biases, our emotions, our tendency towards herd mentality, and also understanding historical trends and observable market patterns is absolutely paramount in making sound, long-term financial decisions. It's not just about crunching numbers in a spreadsheet.
Absolutely. Luck will always play some role, you can't deny it.
Yeah.
But focusing on proven patterns and managing your own psychology are the levers you can actually control and rely on. This whole idea of building foundational knowledge, understanding patterns, and managing psychology leads us directly into tackling something that entrepreneur and author Alex Hormozy talks about quite compellingly. He calls it ignorance debt.
Ignorance debt, that sounds ominous. What does he mean by that?
It's actually a really insightful concept. He provocatively explains that the gap, the difference between your current level, maybe your current income, or your current level of financial success, and a much, much higher level, say earning 10 times what you earn now, or achieving true financial independence.
That gap isn't necessarily about lack of talent or lack of opportunity.
Not necessarily, no. He argues that the gap is often simply the information you haven't yet learned. It's the specific how-to knowledge, the strategies, the understanding of the systems involved, the missing pieces of your personal puzzle that you haven't yet acquired or mastered. That missing knowledge is your ignorance debt.
So the difference between earning $50K and $500 might just be learning how people earn $500.
In essence, yes. It's about acquiring the necessary knowledge and skills to operate at that higher level. You need to pay off that ignorance debt by learning.
Okay, I see the power in that framing. And we can directly apply this concept, can't we, to the world of investing, especially for people just starting out, or maybe even those who've been dabbling for a while but haven't seen great results.
Absolutely. It applies perfectly. As beginners or even as intermediate investors, it's incredibly common to fall into this track of thinking we understand investing a lot better than we actually do.
The Dunning-Kruger effect in finance.
Precisely. We might grasp some basic terminology, stocks, bonds, ETFs. We might know a few popular strategies we've read about online or heard from a friend, and very quickly we can develop what you might call a premature level of confidence.
Yeah, I get investing. Buy low, sell high.
Exactly that kind of oversimplification. We might feel ready to jump into the market, maybe start picking individual stocks, perhaps even taking on more risk than is actually wise for our situation or knowledge level, simply because we've consumed a bit of surface-level information.
And that can be dangerous.
It can be incredibly misleading and potentially very dangerous for your capital if you don't have a truly strong, deep foundational understanding of how investing fundamentally works over the long term. Understanding concepts like risk management, asset allocation, market history, valuation, and crucially, your own emotional triggers. That ignorance debt in investing can lead directly to costly mistakes, chasing fads, panic selling, or just consistently underperforming. So actively addressing this ignorance debt in investing is absolutely crucial. It's about making sound, informed, and ultimately more profitable investment decisions, rather than relying on guesswork, hot tips, fleeting market trends, or the latest hype you see on social media.
It's about taking the time to build that robust intellectual framework first, that mental model of how markets and different investments actually behave.
Yes, building that framework before you start putting significant amounts of your hard-earned money to work. Without that foundation, you're essentially navigating a minefield blindfolded. You might get lucky for a bit, but eventually you're likely to step on something. You're closer to gambling than true investing.
Which raises that important question you touched on earlier. How often do we see people, even supposedly experienced ones, let their emotions or just a lack of deep understanding completely derail their financial plans, especially when things get volatile?
All the time. Market downturns are the ultimate test of whether you've paid off your ignorance debt and built emotional resilience. Panic selling at the bottom, chasing bubbles at the top, these are classic signs of foundational weakness.
Okay, so if someone listening is thinking, right, I need to build that solid foundation, I need to tackle my ignorance debt, where should they start? What are some reliable resources for that core investment knowledge?
Well, two approaches immediately come to mind, offering both timeless wisdom and more accessible modern entry points. First, You really can't ignore the monumental work, often considered the Bible of value investing, The Intelligent Investor.
The Benjamin Graham classic, hailed by Warren Buffett himself.
Exactly. Buffett famously read it when he was just 19 and still unequivocally calls it the best book on investing ever written. And its core principles are truly timeless. They transcend specific market cycles, technological fads, or economic conditions.
What are some of those core principles? What makes it so foundational?
Graham masterfully illustrates that successful long-term investing doesn't actually require you to have specialist inside knowledge or possess superintelligence or have some kind of mystical deep insight into where the market is going next.
Okay, that's reassuring for most of us. So what does it require?
Fundamentally, it requires just two key things. One, developing and adhering to a rational, disciplined framework for making investment decisions. A framework that focuses on assessing the underlying intrinsic value of a business and always demanding a margin of safety, buying assets for significantly less than they're worth.
So, a logical process. And the second thing?
The second thing, which Graham emphasized just as strongly and might actually be even more crucial in practice, is cultivating the unwavering emotional discipline to not let your feelings, fear, greed, impatience, euphoria, override that rational framework, especially when the market is going crazy, either up or down.
Sticking to your rules even when your gut is screaming at you.
Precisely. Graham's work covers everything from understanding how the market behaves, personified as the manic depressive Mr. Market, to the basic financial fundamentals needed to analyze companies and, absolutely critically, the psychological control necessary to maintain a steady hand and execute your strategy amidst the inevitable market fluctuations and noise. It's the ultimate guide to becoming what he called a defensive investor, focusing on avoiding serious losses first and foremost. And that rational framework, that disciplined approach, provides the perfect antidote to the emotional volatility that derails so many investors, doesn't it?
It seems like it would. Can you give an example of that framework in action?
Well, take his famous Mr. Market analogy. He suggests you view the stock market not as some infallible judge of value, but as a business partner, Mr. Market, who shows up every day offering to buy your share of the business or sell you his share. Some days, Mr. Market is wildly optimistic and offers you a ridiculously high price. Other days, he's inexplicably depressed and offers to sell you his share for pennies on the dollar.
So he's moody and unreliable.
Exactly. The discipline of the intelligent investor, Graham says, is to ignore Mr. Market's moods entirely. You don't have to trade with him just because he shows up. You only transact when his offered price aligns favorably with your own independent, rational assessment of the business's underlying value. You take advantage of his irrationality rather than getting swept up in it.
So you ignore the daily noise and focus on the long-term value.
Precisely. And we see people violate this constantly, don't we? Getting caught up in the hype of a bubble, buying high out of fear of missing out, FOMO, or panic selling low during a crash out of fear of further losses. The intelligent investor fundamentally teaches you how to calculate intrinsic value, demand that margin of safety, and then calmly, patiently stick to your plan, even, or especially, when everyone else seems to be losing their heads. Now, while Graham's book is undeniably foundational, some people do find it a bit dense, maybe slightly intimidating as their very first read on investing.
Yeah, it's comprehensive, which is great, but maybe not the easiest starting point for an absolute beginner who feels overwhelmed already.
Exactly. So for those listeners, a more modern and highly accessible entry point could be something like The Girls That Invest approach or book. It's designed specifically for beginners.
What makes that approach good for novices?
It really excels at demystifying the whole world of investing from the ground up. It clearly explains why investing is important in the first place, breaking down the often confusing jargon and complex terminology in a wonderfully relatable, non-intimidating, and empowering way. It covers all the fundamental basics, what are stocks, bonds, ETFs, index funds, etc., clearly and concisely.
So it builds that initial vocabulary and understanding.
Yes, and crucially, it also guides you through the process of figuring out your own investing personality type. This involves understanding your personal tolerance for risk, clarifying your financial goals, what are you investing for, and considering your time horizon, how long until you need the money.
Why is knowing your personality type so important?
Because it's essential for creating an investment portfolio that genuinely matches you. A portfolio you can understand, feel comfortable with, and most importantly, stick with through thick and thin over the long term. If your portfolio is too aggressive for your comfort level, you'll likely panic sell during downturns. If it's too conservative, you might not reach your goals.
So it helps you build something sustainable for your temperament.
Exactly. It complements the deep philosophy of the intelligent investor perfectly by making those initial, often daunting steps of getting started much more accessible and personalized. It helps you build that practical foundation and confidence before you dive deeper into Graham's more complex, timeless principles. One builds the what and why, the other builds the deep how and when.
Okay, so we have the deep philosophy and the accessible starting point. What about specific strategies? A lot of beginners hear about index funds.
Yes, index funds. That brings us squarely into the territory of common sense investing thinking, largely championed by the legendary John Bogle, founder of Vanguard.
The man often credited with inventing the retail index fund, right?
That's him. And naturally, his powerfully simple yet incredibly effective winning strategy, particularly for beginners, but arguably for most investors, is this. Invest primarily in broad market, low cost index funds and just do it consistently and indefinitely. Hold them for the long term.
Why was he such a proponent of index funds over, say, trying to pick winning stocks or actively managed mutual funds?
He made an incredibly compelling, data-backed, almost irrefutable argument for why simple index funds consistently tend to outperform the vast majority of their actively managed alternatives over long periods.
That's the reasoning, lower costs.
Lower costs are a huge part of it, yes.
Yeah.
Actively managed funds have higher expense ratios, trading costs, potentially tax inefficiencies, all of which eat away at your returns year after year. Index funds, by simply aiming to match a market index like the S&P 500, have incredibly low costs.
So the cost drag is minimized.
Massively minimized. Plus, they provide instant, broad diversification across hundreds or even thousands of stocks, which significantly reduces the risk associated with trying to pick individual winners. And third, they harness the undeniable power of simply capturing the market's overall return over time through compounding without trying to constantly outsmart it, which very few active managers consistently succeed in doing anyway.
So his philosophy is basically stop trying to find the needle, the winning stock or manager, and just buy the whole haystack, the market index.
That's a perfect way to put it. Buy the haystack, keep your costs minimal, and let the power of the overall market and compounding do the heavy lifting for you over decades. This thinking also touches upon ideal asset allocation, the mix between stocks and bonds in your portfolio, often suggesting a balance based on your age or time horizon to manage risk appropriately.
It sounds incredibly simple and effective. Almost too simple.
It does sound simple, and that's its beauty and its power. However, while Bogle's core argument for the wisdom of low-cost index fund investing remains incredibly sound and foundational for most people's core portfolio.
There's a but coming.
Well, just a nuance. It's worth noting that some specific aspects, perhaps particularly around the exact recommended asset allocation percentages between stocks and bonds based purely on age, like the old 100 minus your age in stocks rule, might be considered a little bit outdated or potentially overly conservative by some advisors today.
Why is that? People living longer, lower bond yields.
Both of those, yes. Longer life expectancies mean longer retirement periods to fund. Historically, lower bond yields in recent decades mean bonds might not provide the same level of return or inflation protection as they used to, and the availability of more sophisticated, globally diversified investment options.
So the core principle holds, but the specific implementation might need personalization.
Exactly. The underlying principle of broad diversification, minimizing fees, and staying invested for the long term is as relevant and powerful as ever. It just opens the door for maybe further exploration and personalized adjustments within that fundamental index-based framework rather than dismissing the core strategy itself. Maybe you tilt towards certain factors, maybe you adjust the stock-bond mix based on your specific goals and risk tolerance, not just age. But the index fund core remains solid.
Okay, that makes sense. Maintain the core, tweak the edges.
Yeah.
But then there's another school of thought, right? Almost the opposite of just buying the whole market index. I'm thinking of the Peter Lynch, one up on Wall Street kind of philosophy.
Yes, Peter Lynch. Another investing legend, manager of the incredibly successful Magellan Fund at Fidelity for many years. His approach offers a really interesting, slightly contrasting, but perhaps complementary perspective.
Complementary how? It seems like the opposite of passive indexing.
Well, his core principle, famously, is that some of the best investment opportunities are often hiding in plain sight. They're right under your nose. They relate to products and services that you already know well, use frequently, engage with in your daily life, and can uniquely observe as a consumer or maybe even through your profession.
So leveraging your own specific localized knowledge,
Yeah,
your edge.
exactly.
Yeah.
He argued that this specific on-the-ground knowledge can actually give the average individual investor a significant, often overlooked advantage over Wall Street professionals. Why? Because those professionals are often looking at things from a much higher, more detached, purely quantitative level. They're analyzing spreadsheets, industry reports, macroeconomic data.
But they might miss the grassroots trends, like what
Oof.
people are actually buying and loving.
Precisely. They might miss the buzz around a hot new restaurant chain until it's already expanded nationwide, or fail to appreciate the user loyalty to a new software product until its market share is huge. The individual consumer or worker often sees these trends emerging much earlier, just through direct experience.
I actually have a fantastic personal anecdote that illustrates this point perfectly. It really drove it home for me.
Oh, yeah. Do tell.
Okay, so several years ago, I decided it was finally time to get my teeth straightened. I'd always wanted to, but I really didn't want traditional metal braces. So I opted for Invisalign, the clear aligner.
A popular choice.
Hugely popular. And honestly, I was just incredibly impressed with the whole process. The technology, the convenience of the aligners compared to braces, the effectiveness, the customer service, the entire experience was just seamless and frankly, kind of amazing. The results were great.
So you're a very satisfied customer.
Extremely satisfied. And that positive personal experience, that firsthand impact, immediately sparked my curiosity beyond just my own teeth. I started noticing how many other people were talking about it or were also getting the treatment. It seemed like it was everywhere. So I thought, wow, this product is fantastic, and the demand seems
The
huge.
investor light bulb went on.
Exactly. So I decided to look into the company behind it. I found out it was a publicly listed company, Align Technology. I started digging into their financials, reading their annual reports, looking at their market position relative to traditional orthodontics, analyzing their growth potential and future outlook.
You did your homework beyond just liking the product.
Absolutely. The initial insight came from being a happy customer, but then I did the fundamental research to back it up. And based on that combination, the powerful firsthand experience, plus the solid research confirming the business fundamentals, we decided to buy the stock.
And how did that turn out?
I have to tell you, that single investment, Align Technology, turned out to be the one that gave me the biggest return by a really significant margin out of anything I had ever invested in up to that point. It truly stemmed purely from me being a customer, recognizing a superior product and a growing trend in my own life, and then doing the necessary homework to confirm it was a sound investment. It felt like a real Peter Lynch moment.
Wow, that's a truly compelling and powerful example of leveraging that personal insight, that invest in what you know idea. It shows the potential power of it. However,
Uh-oh, here comes the caution again.
well, it's absolutely critical to offer that word of caution because Lynch himself always emphasized this too. While the average investor does have the potential to gain an edge, to one-up the professionals by paying keen attention to their immediate surroundings, their consumption habits, their professional
And
expertise.
not just about liking the product, is it?
Absolutely not. It's not nearly as simple as just saying, okay, I love shopping at the store, or this coffee place makes great lattes, so I'll buy the stock. That initial intuitive step, recognizing a great product or service or trend, is valuable. It's the starting point. But it's only the starting
And
point.
what else is needed?
It still requires a lot more rigorous research, proper due diligence, and a solid understanding of the business behind the product. You need to analyze the company's financials, its profitability, debt levels, cash flow. You need to understand its competitive landscape. Does it have a sustainable advantage? Who are its competitors? You need to assess the quality of its management team, its market position, its valuation. Is the stock reasonably priced?
So the personal insight gets you interested, but the hard analysis determines if it's actually a good investment.
Exactly. It's about combining your unique, potentially early grassroots perspective with diligent, disciplined, fundamental analysis, a structured approach to evaluating the business itself rather than simply acting on a hunch or an anecdote alone.
So index funds offer broad market participation and diversification, low effort. This under-your-nose investing leverages unique insights for potentially higher returns, but requires more concentrated bets and significant research effort.
That's a great summary. Both approaches can be valid parts of an overall strategy, but they demand different things from the investor. Both ultimately require informed analytical decisions, not just gut feelings or following the crowd.
Okay, so we've covered a lot of ground here. We've talked about foundational shifts in how we relate to money assets versus liabilities, the different income quadrants. We've explored strategic paths like the fast lane versus the slow lane. We've delved into the crucial inner game mindset and psychology. And we've touched on practical investing approaches, from broad indexing to finding gems under your nose.
It's been quite a tour through some powerful financial thinking.
As we try to bring all these powerful insights together, drawing these threads from different philosophies and strategies, does one common theme, one universal constant, emerge for you? Something that cuts across all legitimate, lasting financial advice.
Absolutely. I think there is a very clear, undeniable common thread, and it's this. There is no shortcut to genuine, sustainable success, and there are absolutely no shortcuts to legitimately getting rich.
The idea of get rich easy
Oh, yeah.
is just not real.
It's a myth. It always has been, and it always will be. It's usually designed to sell false hope, or worse, to scam people. Any approach that promises massive rewards with little effort, little risk, or little time should be viewed with extreme skepticism.
So if there are no easy shortcuts, what is required? What are the common denominators for success that run through all these different valid approaches we've discussed?
What is required consistently across all paths to building lasting wealth, whether you're an index investor, a business builder, a value investor, a real estate mogul, are certain key virtues. Timeless qualities that transcend any specific market condition or economic cycle.
Like what? What are these core virtues?
Well, number one is discipline. The discipline to save consistently, to invest regularly even when it's boring, to stick to your plan, to manage your spending, to delay gratification.
Okay, discipline. What else?
Persistence.
Yeah.
The ability to keep going when things get tough, when you face setbacks, when the market drops, when your business struggles. Success is rarely linear. Persistence through the dips is crucial.
Makes sense. Discipline, persistence. Anything else?
And perhaps the most crucial underpinning the others is the ability to control your emotions, especially when it comes to money. Fear and greed are powerful forces that constantly try to derail rational financial decision-making.
Like we discussed with Graham and Housel.
Exactly. Markets will fluctuate wildly, that's their nature. Opportunities will appear and disappear, sometimes frighteningly quickly. Our own innate cognitive biases, overconfidence, loss aversion, herd mentality will constantly whisper bad advice in our ears. It's the steady hand, guided by these core virtues, discipline and action, persistence through adversity, and emotional control, to stick to a rational plan that ultimately prevails and builds enduring wealth over the long term. This is the bedrock truth that underpins all the fascinating strategies and philosophies we've explored today.
That's a powerful summary. Discipline, persistence, emotional control. But while all these books and ideas offer incredible wisdom on managing the money you have and investing it wisely in external assets like stocks or businesses, there's one critical point, one area of investment that I feel very few of them truly emphasize with the weight it actually deserves.
Ooh, with that.
It's the paramount importance of putting money towards yourself first. Strategically investing in your own growth, your skills, your knowledge, your capabilities, often before, or at least concurrently with, purely investing in the stock market or other external assets.
Investing in your human capital. You're right, it's often mentioned as an aside, but rarely given the central focus it arguably warrants.
Exactly. It's a distinction that often gets overlooked in the relentless pursuit of purely financial gains, looking for that next stock pick or market timing strategy.
And what's truly fascinating here, when you stop and think about it, is that while we're constantly encouraged to think about external investments, stocks, bonds, real estate, crypto, whatever the flavor of the month is.
The things outside of ourselves.
Right. The single most powerful, versatile, and adaptable asset you possess, the one with potentially the highest ROI, is often you, your skills, your knowledge, your network, your health, your ability to learn and adapt.
How does investing in yourself compare to traditional investing in terms of returns or time frame?
Well, traditional investing, particularly passive investing in broad markets by its very nature, is often a very long and relatively slow game. You're relying heavily on market cycles, the power of compounding over decades, and economic forces that are largely outside your direct, immediate control. It requires immense patience.
Whereas investing in yourself.
Investing in yourself, whether that's acquiring specific high-income skills through courses or training, pursuing further education that significantly boosts your earning potential, starting a business where you leverage your unique talents, launching a strategic side hustle, even investing in your health to have more energy and focus, this type of investment can potentially yield much more immediate, direct, and significant returns, especially in the short to medium term.
Because it directly increases your ability to earn more money.
Exactly. It increases your earning power, potentially creates entirely new income streams, and builds genuine intellectual or social capital that can pay dividends for years, often in ways that compound much faster than typical market investments, especially early in your career or financial journey.
Now, it's probably not as easy as just clicking buy on an index fund, right? Investing in yourself sounds like it requires more effort.
Oh, absolutely. It definitely requires a lot more active work, self-discipline, identifying the right skills to acquire, finding the right mentors or courses, and consistently applying that new knowledge compared to simply setting up an automatic monthly contribution to an index fund. It's not passive.
But the potential payoff is different.
The potential payoff can be significantly higher and faster, particularly in terms of increasing your active income potential. The potential for exponentially increasing your earning power through skills or entrepreneurship, creating new controllable income streams, and building that valuable human capital can often far outpace what most diversified market investments can realistically do in a shorter time frame, like 3 to 5 years.
So it's about cultivating your own abilities first,
Hmm.
which then generates more capital to invest externally later.
That's a fantastic way to frame it. Investing in yourself is arguably your most potent tool for accelerating wealth creation and achieving financial independence because it enhances the engine that produces the capital in the first place. The returns on truly effective self-investment can often be, for all practical purposes, infinite compared to the initial cost. It's the ultimate leverage.
Wow, okay, that puts a really important perspective on things. We truly hope this deep dive today has sparked some profound aha moments for you listening, and maybe given you a clearer, more intentional path forward on your own financial journey.
It's been a great discussion covering a lot of essential ground.
We've touched on so many powerful ideas, from those foundational definitions of assets and liabilities to exploring different income paths, the nuances of getting rich quick versus getting rich slow, the undeniable power of mindset and managing our own psychology around money, tackling that ignorance debt when it comes to practical investing, and just now, the often overlooked yet critical value of investing in yourself first.
And if we try to connect all these diverse insights back to the bigger picture, maybe it raises an important, deeply personal question for you, the listener, to reflect upon after this.
What question is that?
Beyond all the books and strategies and tactics we've discussed today, what single belief about money, success, or your own capabilities are you currently holding on to, maybe consciously, maybe unconsciously, that might be subtly limiting your own potential for financial growth and personal freedom?
That's a deep one. What underlying assumption might be holding you back?
Exactly. Take some time, maybe later today or this week, to truly consider it. Are your deepest, most ingrained beliefs about money truly serving your aspirations? Or could they, perhaps, be quietly acting as an invisible brake on your progress? It's worth examining, honestly.
That's excellent food for thought. Consider which of these powerful ideas we explored today resonates most deeply with you personally, and think about how you might begin to apply just one of them to your own life, maybe starting today or this week. There's immense power in acquiring knowledge, like you've done by tuning in, but there is even greater, truly transformative power in its consistent, deliberate application.
Knowledge into action, that's the key.
Absolutely. Start your own journey of financial discovery in action. The best time, as they always say, is always right now. Don't wait for the perfect moment. Thanks for watching this. See you in the next episode. Like, subscribe, and share.